Hi you guys, welcome back to Progressive Sisters Magic, and today we're going to be going over lesson 7, which is going to be the chart patterns in crypto. Okay, so what I'm about to teach you guys right now can be used for crypto, can be used for forex, for commodities, for stocks, anything. Okay, because the charts are literally the same, but you have to understand the charts in order for it to be applicable to everything. Now, understanding these chart patterns might be a little confusing at first, because when you first open up your chart, you're going to see numbers, you're going to see lines, you're going to see candlesticks, you're going to see wicks, you're going to see times, durations, dates, all kind of things. Okay, but I'm here to break it down for you and make it make sense. Okay, because understanding the charts, it's key. And once you really get a grasp on the understanding of the charts, you'll see that the charts is just telling you a story about the price history and the human psychology behind the movements. Okay, so stick with me throughout this whole lesson, and I am going to make sure that you have a clear understanding of chart patterns by the time you're finished with this video. So let's first go over the concepts and the understanding of chart patterns. What is even chart patterns? What are chart patterns? Chart patterns are recurring shapes and formations that appear on price charts because of how traders collectively buy and sell. Patterns condense market psychology into visual rules: accumulation, distribution, continuation, or reversal. For a beginner, patterns provide a structured way to read what the market participants are doing now and what they are likely to do next without relying on any single indicator. Why should you learn patterns? Patterns simplify decision making. They give clear areas for entries, stops, and targets. They reflect crowd behavior. The same psychology repeats across stocks, commodities, and crypto. Patterns work better when combined with volume, higher time frame context, and risk rules. So like I said previously, these charts, these patterns are literally telling you a story all about price movement and human psychology. Okay, so it's telling you why it's moving, when it's moving, what times it's moving, okay, and things of that such, which direction it can possibly go in and everything like that. So while you cannot necessarily predict the market, if you have a clear understanding on chart patterns, you can definitely have a clear understanding of where you think the market is going to go. You're not going to just enter in a trade blindly. Okay, so like I said before as well, these patterns on these charts are going to let you know when you need to enter, when you need to get out, when you need to have a stop loss, okay, when you have to have your TP, okay, your take profit, and things like that. These patterns are literally going to pave the way for you to understand where you need to place those things at. Okay, now me personally, I do believe that trading psychology is like a big role, okay, big role in trading. Okay, but there's not much you can do with your trading psychology if you don't understand chart patterns. If you don't know how to read a chart, the psychology behind trading is kind of irrelevant in this aspect of making money because you don't know how to read charts. Now let's talk about how to use these chart patterns when you're trying to place a trade. How to use chart patterns. 1. Always check the time frame. Daily, weekly patterns are more reliable than 5-minute patterns. 2. Confirm the pattern with volume. Breakouts with rising volume are more likely to succeed. 3. Wait for a valid breakout. Close above/below the pattern on your chosen time frame, or a retest before entering. 4. Use a clear stop loss, technical level, and a measured target. 5. Manage risk with proper position sizing. Never risk more than your rule allows. Okay, let's go to the first point of these 5 points, and that is checking the time frame. Okay, so your daily and weekly time frames are going to give you a bigger picture of what's going on than the 5-minute, the 15-minute, or even the hourly time frame. Okay, so you have to remember that each candlestick on these charts represent that time frame. So if you're on the 5-minute chart, each candlestick on that 5-minute chart represents 5 minutes. If you're on the 1-hour chart, each candlestick on that chart is going to equal to 1 hour. So same thing with daily, same thing with weekly. So when you have a daily and a weekly chart, just think of every single candlestick is representing 1 week in a weekly chart. Okay? That's a lot of information. That is a lot of price action, price movements, and like a lot of pinpoints for you to go by. Okay? So when you're doing a 5-minute chart, there's a lot of, candlesticks there too still, but it's not a lot of information. It's not giving you information of a longer time frame. It's a shorter time frame, and it's giving you a short amount of information. So the market changes all throughout the day, okay? It goes through so many phases. It's like literally like bipolar. It's just shifting from one thing to the next all throughout the day. So you have to look at the bigger time frames to really understand these chart patterns. Even if you're a scalper, which means that you're just like scalping like really quick and things like that, when you're looking at the larger time frames, you can notice actual patterns, okay? So you'll be like, oh, like during this time, this is when, you know, the price spikes up or something like that, because some cryptos, you know, they spike up earlier in the day or they spike down later in the day. You know, it's just things you have to understand, the price movement and the patterns behind all of it. And the best way to understand that is on the longer time frames, okay? So try your best when you're beginning to look at the hourly, the weekly, and the daily time frames, okay? So now that brings us to our second point, which is confirming the pattern with the volume, okay? So when you have a breakout with a lot of volume, that means that that breakout is going to most likely succeed. And when I say succeed, I mean that that breakout is not just going to be a one-hit wonder, like boop, and then right back down, okay? The more the volume is, the higher the chances that that pattern is going to continue. It's going to like fester into even bigger, okay? So for example, when you have a breakout and there's a lot of volume behind it and it pushes that price up, that volume behind it pushing that price up, the more volume, the more the price is probably going to push up. So if it's a little bit of volume pushing that price up, it's probably going to drop down pretty fast. But when there's a lot of volume pushing that price up, it's probably going to continue to go up because there are a lot of participants inside of the market at that time. The more participants in the market, the more the price is going to move in either direction. All right, number 3, you have to actually confirm that it's a valid breakout, okay? So like I was saying before, you can have a breakout to where it's just a little bitty breakout and then the price goes right back, boop, to where it started, right? No, you need confirmation with these breakouts, because when you have these breakouts, it is detrimental for you as a trader, especially as a beginner, if as soon as you see a breakout, you put in a trade. Detrimental, okay? We need confirmations, we need confluence, we need confirmation after confirmation, we need a retest, okay? So let me go into deep detail about what a retest is, because retest is so important when it comes to trading and understanding these chart patterns. So if you recall, in lesson 6 we went over support and resistance level, okay? So your support is going to be your bottom, your resistance is going to be your top. Now when it comes to retesting, okay, say you have a breakout and you have this support level at the bottom, and you have a breakout and the breakout literally pushes past that support level, it goes up past that support level, what you're going to want before you put in any type of trade is you're going to want it to come and test that support level again and then bounce off of it again and continue in the direction that it was going, okay? Same thing for resistance. You're going to want it to bounce off of that resistance level at least 2 to 3 times before you even think about putting in a trade, okay? Before you even think about putting in a trade, because you need a valid breakout, because because something breaks out past its support or resistance level doesn't mean it's going to continue going in that direction. It can break out for maybe 5, 10, 15 minutes and then go straight back down in the opposite direction, okay, you guys? You don't want to be in a trade when it goes in the opposite direction or when it just consolidates. You don't want to be in that. You want to be in a trade when price is moving. So you need to wait for it to retest either that support line or that resistance line, okay? So you can actually have a clear understanding of the trend and where the market is going, and that is key to understanding chart patterns. So again, remember, we're not putting in any trades until we have a valid breakout with continuous confirmations, okay? Which means continuous retest. Now, number 4 is using a clear stop loss and a target. In target, we're gonna say TP, okay? That means take profit, all right? That's what we say in the crypto world, at least in my Discord, that's what we say. So, stop loss. Stop loss is literally what it is. It's stopping you from losing, okay? It's not saying that you're not gonna lose any money. That's not what it is. It just means that you're not gonna lose as much money. Now, I will say this. As a beginner trader, you probably should use a stop loss and you probably should use a target, okay? But me personally, when I started trading, I did not use a stop loss and I did not use a target. And I'm gonna tell you why. This sounds irresponsible, but let me tell you why. So the only reason that I did not use a stop loss and I didn't use a target was because it's going to stop you, okay? It's gonna put a hard stop, it's gonna close your trade, okay? So, for example, price fluctuates all throughout the day. It could be way up here earlier in the day, way down here in the middle of the day, and then back way up here at the end of the day, okay? So I say that to say, when I use stop losses now and I do use targets now, okay? I do. I just kind of find it like less anxiety in my brain when I implement it, okay? So essentially when you have a stop loss, essentially what you're doing is you're saying, okay, if the price reaches this level or if it hits this price, I want to get out of this trade. Okay, if it hits this price or below, I want to get out of this trade. So I'm minimizing my losses. Okay, now sounds good and dandy, but here's the downside of using stop losses. Price fluctuates all throughout the day. So the price can go up and down, up and down, up and down all throughout the day. Now, if it goes all the way up, you're making money, and then it goes all the way down and you just lost all that money, and then it goes all the way down right here to where your stop loss is and you get closed out of that trade, but then 5 minutes later it goes way back up all over again, like higher than it did before, you just lost money. You could have gained profit if you would have stayed in the trade, because it did go way up again, higher than it did before. But because you had that stop loss, you actually end up losing money. So you got stopped out of a trade. All right? Same thing with target. Target is making sure that you get your profits in, all right? So now when you have a target, when it hits that target, your trade is going to close, all right? So say the price goes up way high, it hits your target, and then it closes immediately. The price can keep going higher and higher and higher and higher, and you lost out on all the profit that you could have made. So targets are used to ensure that you get profit, and stop losses are used to ensure that you don't lose a lot of money. Now, both of them are infringing upon your trades. They're closing out your trades and you don't have no say-so about it. I mean, you do have say-so about it because you're the one who placed the stop loss and who placed the target, but at the same time, it's just like, so when I was a beginner trader, I was very risky. I'm not saying you guys should be risky, but I did play around with the charts a little bit to really understand it. And so I did not use stop losses and targets. There are some times when I didn't use a stop loss when I really wish and prayed that I did, and there's other times when I didn't use it and I was so happy that I didn't use it. So everybody is a different kind of trader. If you're a high risk trader, or if you're I don't want to take risk, I just want to make guaranteed money trader, whichever one you are determines whether you use stop losses or you don't, whether you use targets or you don't, okay? As a beginner, especially someone coming from an experienced trader, I do believe that you guys should be using stop losses and targets just to ensure that you're making money when you first start off, okay? That's just my personal opinion, because you don't want to start trading and then immediately just start losing money. You're going to lose your momentum. You're going to lose your account. And then also on top of that, you're just gonna lose like the drive to trade, you know? It's not gonna be that fun of an experience. I mean, of course you're gonna push through it if you really wanna be a trader. If that's part of the game, you're gonna have to push through it. But if you're like treading, you know, the line, and if you wanna be a trader or not, go ahead and use those stop losses and those targets so that you have a fair chance of actually experiencing what the market is like. All right, and that leaves us with number 5, which is going to be managing your risk. That means managing how much you're leveraging and managing your position sizing. These two things can make or break your account, okay? You can understand charts, you can have good psychology, blah, 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 right? But if you have the wrong position sizing and the wrong amount of leverage on a trade, you can totally blow your entire account in a snap of a finger. I cannot make this up, you guys. So position sizing and leveraging how much you're actually going to be placing into a trade is very important, you guys. All right, very important. You, as a beginner trader, when I first started trading, we used the 10% rule. You don't leverage more than 10% of your account. You don't have a position size that would equate to more than 10% of your account. That was a 10% rule. Okay, and then as you make even more money, you can start leveraging a little bit more at a time, but at no point in time should you be like leveraging 75% of your account, 100% of your account. No, you shouldn't. No matter how much of a trader you are or how big your trades are, you should never be leveraging that much. So when you have a clear understanding about how much you want to leverage, your position sizing and everything like that, that is called risk management. It's called risk management because it's managing the amount of risk that you are placing upon yourself, okay? You don't want to automatically just place a lot of risk on yourself. Of course, trading is a risky market, but you want to kind of stay away from the risk as most as possible, okay? Like try to stay away from that. Try to be like more towards the money and less towards the risk, all right? And I know I say scared money don't make money, but some things are just not smart decisions. It's just not smart. Okay, it doesn't mean that you're scared because you don't want to risk your entire account on one trade. that doesn't mean you're scared. That actually means you're smart if you don't want to, okay? So that's actually smart money, okay, instead of risking money. So it's really up to you. But as a beginner trader, I started off with the 10% rule. I think that was even too much. So I say you guys should start off with the 5% rule, okay? And I know you're gonna be like, 5%? That means I can't even start trading big. That's fine. Trading is a compound effect, okay? When you first start, the small gains really add up over time. And if you're a consistent trader and really studying the market and really know what you're doing, those small gains, one day you're gonna wake up and be like, whoa, I have like 100K in my account, okay? Literally. So it's a compounding effect. Don't be so quick to be putting so much money into your account just to blow it on one trade because you didn't do your position sizing, okay? Now let's move into the different types of chart patterns. Types of chart patterns. Reversal patterns, signal change of direction, double top / bottom, head and shoulders, inverse head and shoulders, triple top / bottom, rounding bottom. Continuation patterns, pause before trend continues, flags, pennants, rectangles, triangles when they form during the trend, channels. Neutral / context dependent patterns, symmetrical triangle, could break out either way, wedges, often reversal, gaps, rare in 24/7 crypto, but still relevant. So the first thing that we're going to go over is a continuation type of pattern. But in order to understand a continuation type of pattern, you have to first understand a consolidation. So consolidation means exactly consolidation. It means the price is consolidating, okay? So that means that the price is kind of stagnant. It's not really going up, it's not really going down, it's pretty stagnant. And that is essentially where orders are gathering, okay? There's a lot of orders on buyers and sellers gathering before it wants a breakout or before it really starts a trend, okay? So that is the first key of understanding that you need before you can fully understand a continuation. So when you have a continuation, that means that it's going to continue the price direction that it's going to go. So let's say you have a breakout and then you have a slow consolidation phase where it's just like not really moving that much, it's pretty stagnant, and then you have a continuation in the same direction that you had that breakout, and that is validation that the trend is going in whichever direction that it's going, okay? So for example, let's say the chart starts off right here. It's going up, and then it's stagnant, right? So this going up was a breakout, but then it's pretty stagnant, not too much going on. It's a pause, is exactly what it is. It's a pause in the price movement, and then it continues to go up again. Okay, so that's a continuation. It's continuing to go up from the price that it was going up before it hit that consolidation phase, and then it continues to go back up, okay? So that's why it's called a continuation. Now that you know the understanding behind a continuation, let's see how we can actually read it on the charts. Continuation patterns, triangles, ascending, descending, symmetrical. What are they? Ascending triangle, horizontal resistance line on top, rising support line below. Buyers make higher lows while sellers defend the same resistance, bullish bias. Descending triangle, horizontal support below, falling resistance above, bearish bias. Symmetrical triangle, converging lines, both buyers and sellers making smaller moves. Neutral, breakout can be either way. Why they form? Market pauses and consolidates. One side slowly gains advantage, ascending equals buyers gaining, until liquidity is taken and a breakout occurs. How to identify? At least 2 touches on each trend line, 3 is stronger. Lines should converge, the pattern looks like a triangle. Volume confirmation. Triangle formation usually sees declining volume. Look for a volume expansion on breakout. That makes the breakout credible. Time frame and reliability. Daily 4-hour triangles are reliable. 1-minute triangles often are false. So in the lesson in the PDF, there are clear visual examples of what I'm talking about these ascending, descending, and symmetrical type of triangles. So if you go on the PDF, you'll be able to really see what I'm talking about, okay? And you'll be able to see the breakouts or the expansions or the consolidations just by looking at those images on the PDF. And I do recommend that you guys go ahead and look up even more images like on Google. And then when you have your charts, literally, you should have already made a TradingView account. You should already be playing around and marking up those charts. I want you guys to mark up those charts with the descending triangles, ascending triangles, and the symmetrical triangles. Also, mark up the consolidation phases. If you see an expansion or if you see a breakout, okay, I want you to do that as well. And you're learning about continuation, so I want you to really like label it as a continuation when you see it on the chart. I believe that you labeling these charts and really looking at these chart patterns and studying these chart patterns is the key to success, because that is how you actually get a grasp on it. Me just telling you, me just reading to you what it looks like does nothing for you if you don't have the actual visual in front of you. So when I'm talking about the ascending triangle, I did mention that the buyers are making higher lows, okay? And that the sellers are trying to push for that resistance. They're trying to keep it at that resistance level, okay? So if you remember, higher highs and higher lows equals what type of price structure or what type of price environment? You got it. That means bullish. That means you have a bullish bias. That means you are entering a bullish market, okay? So you can associate those type of triangles, the ascending triangles, with a bullish market. So that means when you see a descending triangle, that is going to be representing, or it's going to be in the bias of, a bearish market. But really, you can just kind of correlate those words with each other. Ascending means it's going higher, and when it's going higher, the price means that it's bullish. Okay, descending, that means it's going lower, so that means that it's bearish, because when things are going down, it's a bearish market. So a symmetrical triangle, you guys, it's purely neutral. There could be a breakout or expansion to either direction, okay, up or down, either direction. So that's when you really have to look and study the charts. Do not place a trade when you are seeing a symmetrical triangle. That means you are seeing a consolidation. Do not place a trade, because the price can go either way. You need confirmations after confirmations to see that it's a valid breakout before you ever place a trade. So that brings me to our next point of when I was talking about how to identify it. You want to have multiple confirmations. So 2 confirmations, people might say, oh, that's good, but you need to have 3. I'm sorry, you need to have at least 3 confirmations. If you don't have at least 3 confirmations, maybe you should just sit it out, and it's okay to sit it out, okay, you guys? It's okay to sit it out. There is money to be made in the market 24/7, because crypto is a 24/7 market. So just because you sit out for 1 minute doesn't mean that you're not gonna make any money, okay, you guys? That's not what that means, okay? Wait for it to touch that trend line 3 times, to give you confirmation at least 3 times, and then put in a trade. And make sure there is volume behind these breakouts for it to be an actual valid breakout, a good amount of volume, okay? I said that before, but I want to reiterate again. Make sure it's a lot of volume, okay? So that typically means that the breakout is going to continue, maybe. That it's going to continue, it's going to succeed if it has a lot of volume behind it. If it doesn't have a lot of volume behind it, take a seat. Also, when it comes to these time frames, you guys, look at the hourly, the 4-hour time frames and things like that, and really study those time frames. Do not do the 1 minute, do not do the 5 minute, 10 minute. No, those are false breakouts, okay? Because you're seeing in that 1 minute time frame, you are seeing a 1 minute candlestick. So it's showing you something that happened in 1 minute. So as fast as it can go up in 1 minute, it can go down in 1 minute. So that is false, okay? Look at the 4-hour, all right? Look at the 4-hour. Now let's go over some common mistakes that happens when we're looking at these continuations. Common mistakes: entering on the first wick, poke above resistance, no close. Ignoring volume, using tiny time frames for big targets. So that literally just wraps up exactly what I just talked about, okay? So you're ignoring the volume, so you're not seeing that there's not a lot of volume going on, and you're putting in a trade anyway. Volume can make or break your trade. Let's start there. Then on top of that, you're not getting enough confirmation. You see one little wick, go in the direction that you want, and that's your confirmation. There's not even a close. No, you cannot do that. You need actual valid confirmation for these breakouts. And then number 3 is the time frames. Make sure that your time frame is going to be on the 4-hour and above, okay? The 1 minute, the 15 minute, and things like that, they can give you false predictions, and that can really hurt you as a trader. So we talked about triangles, and that is how you can read the charts and the patterns when it's coming to this continuation phase. But now we're going to talk about flags and pennants, which are also a visual representation of how you can understand the continuation phase. Flags and pennant. Flags Sharp preceding move, flagpole, followed by a small rectangular consolidation that usually slopes against the trend. Pennant, like a small symmetrical triangle after a sharp move. Why they form. Market catches its breath after a large move, short consolidation, then continuation. Volume, high volume on the pull, low volume during consolidation, high volume again on breakout. Time frame, often short term, minutes to days, but can appear on larger time frames as well. So again, on our PDF for lesson 7 on our school platform, you can go ahead and find these images there on our PDF to have a visual representation of these flags and these pennants. But the story is being told with these flags and pennants. Remember when I told you that these chart patterns and stuff are literally storytelling? They're telling you a story about price movement. So those flags and those pennants are literally telling you a story. Okay guys, it's telling you price is going up, and then there's a consolidation phase, and the price goes back up, and then that is represented through flags and pennants. That is the visual representation of the story that the price is trying to tell you. Okay, so I do recommend that you go on your trading view and mark up your flags and your pennants, and then also take a really deep look at the images that we have on our PDF on our school platform. Now next, let's talk about the rectangles. Now honestly, I'm not gonna lie to you, I don't really use the flag pennants and the triangles and all that. I am a rectangles type of girly, okay? Rectangle type of girly. It's just so much easier to understand for me. It doesn't put all these different marks all over my chart. I am more so a person who learns more from words, not from visuals. So when there's too many visuals going on, it's just gonna confuse me, and I'm just gonna get lost in the sauce, and I'm gonna be like, you know what? I don't understand. So I like my charts to be very clean, concise, and labeled, okay? I still like to mark up my charts, but I don't want to see lines everywhere, okay? Now, some people are really good traders when they have all those lines and everything everywhere. I don't know, maybe it's the OCD in me, but I just can't. I'm a rectangles type of girly. So I'm going to tell you about the rectangles as a part of this continuation phase and how to actually read it on a chart. Rectangles / consolidation ranges. What are they? Price oscillates between horizontal support and resistance, creating a box. How to use. Range trade. Buy support, sell resistance. Requires tight stops. Breakout trade. Enter on break of box boundary. Target equals box height projected from breakout. Stop. Opposite side of box or just beyond invalidation level. Volume. Volume often falls inside box. Spikes on breakout. When to prefer. When trade proceeding, the rectangle is strong. Breakout usually continues the trend. We went over consolidations, we went over patterns, over volume, why those things are important, you know, and how these charts are really telling you a story, and all you have to do is really listen to it. Listen with your eyes and with your brain. They're trying to tell you something. They're trying to tell you, hey, come make this money. But you won't understand if you don't actually read and understand the charts and the patterns, okay, you guys? So like I said, we are putting a hard stop right here, and then we will start lesson 7 part 2 in my next video. But until then, go mark up those charts.